Hello, everyone, and welcome to another episode of the Candlestick course for beginners. My name is Mr. Crypto Tracker, and I'm going to teach you how to trade with candlesticks. Before we start this episode, please make sure to subscribe to the channel if you didn't do it so far, and also turn the notification bell on to get notified when a new video comes. So far, I discussed the fundamentals of candlesticks, how to read a candle, and also I talked about spinning tops and high wave candles. I hope you practiced the previous episodes and now you are ready to learn about a new candle line in this episode, which is episode number 5. In this episode, I will focus on a powerful single candle line known as dojis. Doji plays an important role in candle charting techniques. When it appears in an uptrend, especially in a zone of prior resistance, it can signal a significant trend shift, or we can call it reversal. Naturally, candles subsequent to the doji's appearance confirm the potential reversal or potential turn. So in this episode, you are going to learn these points. You will learn the definition of a doji candle, how to identify different types of doji. You will learn about the importance of doji when they appear in an uptrend or downtrend. And also, you will learn how to interpret a doji when it forms in a box range. A doji is a candle in which the opening and closing prices are the same. As you can see here, they are either the same or they are very close to each other. Therefore, it resembles like a cross as you can see here. Like the spinning top, the doji indicates a market in complete balance between supply and demand. Since a doji session represents a market at the juncture of indecision, it can often be an early warning that a preceding rally could be losing steam. Japanese place great significance on the power of doji candlesticks, especially in the context of a market experiencing a major uptrend. And when this candle appears, either alone or included in a 2 or 3 candle pattern, it warns you that the trend shift may be in the offing. So this candlestick is so important to learn and place them in any charts. The ideal doji forms with the same opening and closing price, but this rule is flexible too. When the opening and closing prices are only a few ticks from each other, you can still consider the candle line as a doji. You can see what I mean in this photo. They open and they close. They are very close to each other, or they are at the same price. Doji candles are extremely valuable at calling market tops, especially after a long green candle. But they sometimes lose signal potential when defining market bottoms. The doji's possible negative influence at trend tops comes from its warning that the market is indecisive. So a close over the doji's high could be a signal that the bulls have regained a foothold. Also, a doji's appearance in a rally might signal an exhausted market. A doji's emergence in a downtrend may not signaling a bottom. This is a very important point, and I will talk about it more in the coming slides. So let's summarize what we learned about dojis so far. A doji reflects a market in a state of transition or indecision. You should be stay cautious when you see a doji after a tall green candle in a strong uptrend. This is true whether the doji is within the prior long green body candle or above it. A doji often works better as markers of top reversals than bottom reversals. The doji signal is more powerful if it appears at a resistant level. When it appears in an uptrend, especially in a prior resistance zone, it can signal a significant trend shift or reversal. If a doji appears in the middle of the trading range, just simply ignore it. The candles after the doji's appearance confirm the potential turn. Doji can often be an early warning that a preceding rally could be losing steam. They are extremely valuable at calling market tops, but sometimes lose signal potential when defining market bottoms, and a close over the doji's high could be a signal that the bulls have regained a foothold. There are different types of dojis, and depending on the placement of the open and close price on the session, some doji have nicknames. These doji are still reversal indicators, but they hint at more positive or negative outcomes. A few of these specially named dojis, which we are going to talk about in these episodes, are just we have the common doji like this, then long leg doji, which has a very long upper and lower shadow. Another one is the Gravestone doji and Dragonfly doji. Let's start with Dragonfly doji. The Dragonfly doji forms with the open and close near or at the high of the candle. This is a schematic view of the Dragonfly doji, and you can see the open and the close is almost at the high of the candle. This candle emits bullish implications. Its long lower shadow shows that the market fell sharply. This long lower shadow, as you can see, this indicates the market fell sharply during the session, but buying pressure pushed the price back up to the close at or very near the session's high. If you're thinking this doji resembles a hammer but without the real body, you're correct. This is like hammer, but as you learned in the previous episode, hammer had a body, a real body, but these candles, they don't have a real body. Another point is you have to pay attention when you see the Dragonfly doji emerging during declines that have become oversold, as you can see here in this chart. Normally, doji in declines or in downtrends are not important, but Dragonfly doji is an exception, and you have to take them serious. The bearish counterpart to the Dragonfly doji is the Gravestone doji. You can see the Gravestone doji here. The Gravestone dojis open and low and close all reside at the bottom of the candle. You can see here the open, close, and the lowest price, they are almost at the same price, at the same place. From the shape of this doji, you can understand its name. So it looks like a tombstone, so they call it Gravestone doji. One important point you have to take it seriously is the doji is more influential when it is a rare occurrence. If numerous doji have formed on a particular chart, do not view the development of a new doji as meaningful. A strong point about the Gravestone doji is in calling top reversals, as you can see here. They usually appear on the top of an uptrend. Imagine an uptrend becoming overbought, rising on green real bodies. As you can see, we have an uptrend and we have two long green candles. Perhaps a glance at the chart tells you that the recent resistance at this same price level is also in place. So now the Gravestone Doji appears, the market opens, rises to a much higher price. Market open here, rises to much higher price, as you can see, then falls to the lower of the session and close here. For the moment, at least, the bears have won control. Here at this point, we can conclude the bears are in control. If the next candle falls to the downside, the signal is completed, as you can see here. One important point here is if the candle that forms after a Gravestone Doji rises above the high and culminates in a long green real body or other positive candle line, the potential trend reversal signal given by this Gravestone Doji is invalidated. So this is very important. So look at this chart about the last point I just mentioned. Here we had a Gravestone Doji. It's almost like Gravestone, but not a perfect one. But you can see in the next candles, they went to the higher price of the high of this candle. But again, we have another like Gravestone Doji, and the next candle confirms this Doji. Yep. Let's summarize what we learned about Doji candles. Dragonfly Doji emits bullish implications. The Doji in declines are not important, but the Dragonfly Doji is an exception. Gravestone Doji emits bearish implication. The Gravestone Doji's strong point is in calling top reversals. And after the Gravestone Doji, if the next candle falls to the downside, the bearish signal is completed. Another point about Dojis is when the market is rising and overbought, and then a Doji appears after a tall green candle, like what you can see here, we have one Doji here and one Doji here. The Japanese say that the market is tired. A Doji's emergence may not foretell an immediate price reversal. It may only suggest that the market is vulnerable and susceptible to change. So a trader can use the highest high between the Doji and the prior candle as resistance. Here is the high of the Doji and here is the high of the prior candle, and this area, this is our resistance. If the market closes above this area, then Japanese say the bulls are refreshed, and basically these, like above this area, is our invalidation level. If we entered in a short trade here at this price, then we have to put our stop loss above this level. So it was the end. This is the end of the episode number 5. We talked mainly about Dojis. For your practice, please go on different charts, different time frames, and try to find different kind of Dojis you just learned in this episode. And also, it would be a good idea to watch these videos a few times, because you cannot perfectly learn it with just watching them once. You need to go back and watch them a few times. Each time you can learn a new point. So that's for today, and see you on the next episode.